What's going on, everyone? Brian's here. Today is Saturday, February 20th, 2021. And what we're looking at is the daily time frame for the company Palantir, ticker symbol PLTR. Now let's pull up the active trader window so you guys can see my position. I'm currently long 300 shares with an average price of $25. Now I actually started purchasing these shares yesterday, which was February 19th. However, PLTR was at $25 on Thursday, the day before. I'm going to show you guys how I managed to get my cost basis also at $25. So even though I purchased them on this day, let's look at where the company is currently trading at after hours, and we can see it's all the way up here. So from $25 to up here, that's about $475 per 100 shares. We bring up a calculator over here, we see $425 times 3 because I'm in 300 shares. That's about a profit of $1,425, and that's pretty much roughly where my overall P&L is on the trade so far. Now, showing you guys exactly what I did. I sold puts on Thursday, so we're going to walk through why I did that, and I collected the premium on Friday. I used some of the profit in that trade, as well as scaling out of some shares that I purchased at the open yesterday. I used some of that realized profit, and I ended up rolling that right into buying an in-the-money call option that expired the same day for $8. So pretty much the goal, or the main thinking, was how can I come up with $800 in realized profits to put into an in-the-money strike that was expiring, and let that contract expire so I can be assigned after hours, thus having someone sell me 100 shares for $20, bringing my average down even though I purchased it on this day. So jumping right into the inner workings, let's close this out and go back and focus on the daily chart. I'm going to hide this because this is not necessarily important right now. I just wanted you guys to see that my profit matches exactly where my cost basis is. Unless you've been living under a rock or you're new to trading, you've probably heard of this company. And try not to spend too long on the technicals. Let's just point out a couple things here. Let's take a look at this technical triangle right here, and most traders are aware of how to trade a breakout and so forth. I didn't participate in the momentum move back here. Now, this video is not financial advice, but in my personal opinion, this is a company that I would love to be long bullish for a few years, if even. It's not just a momentum trade in my eyes. And leaving fundamentals out of the story, we're just going to look at the technicals. This was a breakout, and a beautiful breakout at that. Back then, during this initial run-up, I'm not participating in it. I wanted to wait until news came out. I wanted to let the company have a little bit of time on the market to have proper discovery for price. $25 is a beautiful level. If we look at the weekly chart, we'll see we have this beautiful flag, a pennant, however you want to digest it. Let's just doodle on the chart here. We see here's our pole. And then what we have is this flag, if you want to look at it that way. Another trader might look at this chart and say what we have is a bull pennant right here. So here is our triangle. Now, in case you did not know this, whenever we have a pennant that breaks, whenever price retraces back to the apex of that triangle or the apex of that pennant, you'll usually see it hold as a strong demand zone. On top of that, we already know that there was a lot of volume that was traded at this level by looking at volume profiles and stuff like that. So let's jump back to our daily time frame. And that's one reason why $25 was always a level I was interested in this company. After it broke out from here, I was just waiting patiently for it to come back to here. Now, you could argue that I was probably too patient because I actually didn't buy it when it came down to 25. I waited till the following day. But even though I waited, I still ended up getting exactly what I wanted, which was owning equity in this company at this level. Next, I want to point out something very important for any trader that uses technical analysis. During the IPO, we can see this company traded over 330 million shares, almost 340 million shares. And then when we came back down to $25, we traded about 313 million shares. That's the highest amount of volume since the IPO, and that's something that's very significant because this is following a downtrend. A lot of volume came in right here, so this is reading as absorption. If we go to an intraday chart and let's look at something like the hourly, we'll see that this was Thursday. This amount of volume that came in was over 90 million shares in 1 hour. That's very important. Again, it reads as absorption, and even though price was trying to hold and break below $25, it could not hold. Someone was buying aggressively. In this particular case, we have an idea of who it was, as Kathy Wood, who's the CEO of ARK Invest, already made it public that she was bullish on this company over the long term and that she was going to be buying shares. She's been aggressively buying, so we can interpret it whether it was her or not. It doesn't really matter. All we know is that there was a lot of buying and there was someone holding and supporting price. Now, if I was just to buy the 300 shares right here and I was wrong and this company gapped down or it continued to sell off, it would mean that I would be holding a position into the red, and then I would have to think what's my next level to risk off of. We do have this level on a daily time frame, which is about $23. We also have a level down here if you're just pointing out other support lines and stuff like that. But instead of predicting where the bottom was or trying to catch a falling knife, which is not something I suggest if you're a new trader, I decided to play it patient. But at the same time, this pattern right here on the daily time frame with the gap down, and it was holding. I remember thinking early on Thursday, if this ends up closing as some sort of doji or something like that, and then we get a gap up, we would have what's called a Morningstar candlestick pattern. And if you're not familiar with what that is, you can just Google what's the Morningstar candlestick pattern, and it's just to give you an idea. Now, I don't encourage you guys to take trades just off of candlestick patterns. That's not my reason for getting into the trade. As I've already mentioned, I actually didn't even buy the shares here. I'm not someone that trades just off of candlestick patterns, but you do want to be aware of them because sometimes they can add an extra reason for you to get into the trade. And the more reasons, the more confidence you have, the more success you'll have as a trader. So what did I do on Thursday? Let's go to our intraday time frame. And here we have our 15-minute time frame. Here is it holding at 25 in a 15-minute time frame. So what did I do on Thursday? As I mentioned earlier in the video, I decided to open what's known as a credit spread. In this case, it was a bull put spread, which means I sold the $25 put. I could have been any strike price. I decided to sell the $25 put for a month out because the thinking was this company, PLTR, is not going to close below $25 within 4 weeks. Even if it was to gap down again, I would have been able to hold this position without having much risk on the table. And to essentially hedge that position, I bought the $20 put with the same expiration, which means this trade did not require as much capital. So by selling 4 of these, if I did not buy 4 of these, it would have meant I needed almost $10,000 in capital. How do you derive a $10,000? Selling 4 of these puts at the $25 strike price is essentially saying, think of it as saying I'm pretty much buying 400 shares right here. And by buying 400 shares right here, that's $2,500. $2,500 times 4 equals 10 grand. That becomes $10,000 in capital in the market. I was not willing to take that trade just yet, but by selling the $25 put and by buying the $20 put, I was essentially reducing how much capital I needed, thus allowing me to hold if we ended up gapping down a little bit further. And how do you do that, you might be wondering? If you go to your option chain on any broker that you're using, and let's close this out and go to the expiration I was looking at. Here we have, which was pretty much the monthly expiration for March. I can come here, and if I was to sell this option, you guys can see, obviously at the time when I sold it, the price was significantly higher. If I was to sell this right now, this would be my max loss, which is essentially how much collateral I would need. Because if PLTR was to close below this price, I would have to sell the shares to someone for that price. And that's why you would need to have that much money in BP. And if I was to just edit this, as I said, I sold 4 of them. So by selling 4 of them on Thursday, the required BP was about 10 grand. So to counter that, if you buy the $20 strike, let's just reduce this back to 1. So by buying the $20 strike, it's going to reduce the most amount of profit I can make, but that's fine because now it means look at how much capital is required. Only $369 in this case. So if I was to just bump this up to 4, which is actually the amount of size I did, increase this up to 4 here. Let's hit send. You guys can see now the requirement is only $1,400. Again, at the time I did the trade, it was only about, I believe, $1,050 or something like that was the required amount of capital, and the max gain was about $950 something. So pretty much it was about a 1-to-1 risk reward ratio. But the risk reward ratio is not what matters here. What's more important is the thinking behind the trade. And as I mentioned, I wanted to buy this company at 25 anyway. So I was fine with risking essentially $1,000 over the next 4 weeks for this company to end up closing over 25, and that means I'd be able to pocket the credit or pocket the premium that was paid out to me. And how this trade played out was that it only took 1 day. So here's the option, make it a little bit larger for you guys. I sold 4 of these for $3.23, and as you can see, I bought them back the next day when they pretty much lost half of their value for much cheaper. So I was able to pocket the difference, what ended up being about almost $1.50 per share. So on 4 contracts, it's about $600, we'll say. We'll just round it up and estimate it to be about $600 in profit. And on the put that I purchased, as you guys can see, I purchased these for $97. These dropped to $37. I lost nowhere near as much on this trade here. So by buying those back and closing that spread, I essentially had realized gains, and I used that profit to put towards the in the money call that I ended up buying. So now what did I do on the open of Friday? Noticing from pre-market that PLTR had already gapped up, I decided that I wanted to be buying the shares today because now this would be completing what could potentially be this morning star pattern. But instead of waiting for the end of the day to find out, I decided to start building the position at the open. So let's go check out my fills. If I just jump right over here, here's the smallest time frame which I look at. It's just a tick chart. It's showing you guys what I did. So 4 minutes into the open, this is 9:34. You guys can see I purchased 200 shares at 27. 27 was a nice level from technical reasons, as well as I was looking at the price action as well as seeing how it traded during pre-market. It was also a retracement from a pre-market low to an open session high, and it pulled back. I was happy buying 200 shares at 27, and at this point I already knew I was going to be realizing my gains from the put that I sold the previous day. Then as PLTR started running up, I decided to sell 100 shares at $29. Why did I sell at $29? If we jump to our daily time frame, keeping it pretty simple, this is the 50-day moving average. It was around roughly $29. I figured it was a good place to take off my momentum lot. A lot is just 100 shares. I had 2 lots. I decided to sell half, which was 1 lot right here, which means I realized $200 in profit. Now I already realized roughly, we'll say $400 in profit from the spread. So therefore I had realized $600. That's $600. I was thinking I needed to put that money to use somehow. So that's when I started eyeing this contract right here, which was the $20 call option that expired the same day. This was a 0-day in the money call option, and I knew I wanted to buy it around this price because I figured I could put up about $800 of realized gain intraday to be able to afford this contract essentially for free. Now, how did I get the perfect fill at $8? Again, using simple technical analysis. As you guys can see, I bought back my 100 shares at 28. I decided 28 was a beautiful level. If we go to another time frame right here, which is the 3 minute, which is usually my favorite one when I'm actually intraday trading, and we'll put the $28 up right here. There's $28. Now most technical traders, we know when something runs up, when something gaps up and then it runs and it meets resistance and then it breaks out, there's a momentum trade there. But when price retraces back to that level and holds, it's usually a good place to get in. And as you can see, $28 held up like a champ. So I was actually one of the early buyers buying it around right here. And at the same time, that's when I decided to buy this. That's exactly when I decided to buy this option. As you guys can see, my crosshairs are synchronized. So you can see I bought right here at the same time this was holding. So thus, I essentially bought this contract for free, or I used my realized gains to actually purchase that with the plan to let it expire worthless. Now, in a previous video, I pointed out how this is one of my A+ setups. Whenever there's a company that has been on a downtrend, turning pre-market data off, it's very easy. Just keep your trading simple, guys. You turn it off, a stock gaps up, you don't have to participate in the craziness at the open unless you have another plan like I did, because obviously I was a buyer right here at 27. If you're looking to trade some momentum, but you always find that you don't have a lot, but you realize you don't have a lot of success trading at the open because it's very choppy, just wait for a stock that's been on a downtrend to gap up on elevated volume. As you guys can see, the RVOL that came in was significantly high. It was over 13 million shares traded on this company within the first 3 minutes. That's very significant. Let price figure itself out for a bit. Sit back, wait, be patient. And then I pointed out, whenever you have the 9 EMA, which is this blue indicator right here, and VWAP, which is this gray indicator right here, they generally cross at 10 a.m. As you guys can see, this is 10 a.m. on the chart right here. Whenever you get this cross, it's almost always happening exactly the same time, but the time is not really what But the time is not the most important thing. It's just, it could happen at 9:45, it could happen at 10:15, it can happen at 10:10. It's just interesting because it usually always happens at 10 a.m. or 10:15 or something like that. In my experience, whenever you get that cross and momentum starts building up, you can take the trade right here, or you can wait for the breakout and you can use this down here as your stop loss. So it ends up becoming a trade where your risk is essentially this much right here, because this would be your stop loss below that level, and your reward can be ride the momentum, and you can close the trade if you hit a certain profit target or once we break down below the 9 EMA. It ends up becoming a very, very easy trade, and it happens over and over. I'll put a couple links in the description down below on a couple of videos in which I covered this exact specific setup. But from a risk reward standpoint, you would essentially be risking, in this case, 30 cents or 1% to make at the maximum amount of profit over $2 or 7%, and at the time of actual closing, if you follow it exactly to the T, $1.50. You're pretty much risking 30 cents to make $2.50. So essentially it's about a 1 to 5 risk reward, which is an amazing trade from a risk reward standpoint. Let's just delete some of this stuff right here, remove that. So as you guys can know, I bought 200 shares right here. I sold 100 shares right here because of the 50-day SMA. I bought back the 100 shares right here. This is also around the same time I closed out on the credit spread right here, as you guys can see. So I collected, realized some gains here, and then I put the money back to work back here. And at the end of the market, this call ended up expiring in the money, and whoever sold me that option ended up being assigned, so they had to sell me the shares. And if we pull the calculator up real quick, having 100 shares at $27, then having another 100 shares at $28, then having 100 shares at $20 equals 75. Divide that by 3, and that would be my average, $25 per share. And that's exactly what you guys can see right here when I open up the active trader. And then again, if we go to the after hours session, we can see from here, from $25 to here, I'm essentially up $4.75 per share. In this case, I have 300 shares, so I'm essentially up $475 per lot. I have 3 lots, which is 300 shares, equals $1,425 in profit. And as you guys can see here, that's pretty much my P&L open minus commissions, and I sold an intraday put on it that I ended up closing by pretty quickly and stuff like that. But overall, the point of this video was to show you guys, by being patient, instead of catching the falling knife, I was still able to get into a company that I would love to be in long. And now that I have the 300 shares, I'm going to be selling calls and puts on it, especially since the IV on this company right now is over 100%. This is really good for option riders, and the March 5th contracts, I'll most likely be selling a lot of these next week and trying to trade this intraday while I continue to hold my core position. I would love to work my way up to 500 shares by owning 3 lots at $25. I essentially have $7,500 in PLTR right now. I would like to work my way up at least $10,000, which would be 400 shares, and I will figure out a way to get my next 100 shares with the same average, so I keep that down there, as well as collecting premium. Hopefully this video helps you guys. I haven't seen anything like this online before, and I think it's a great way to trade if you're not distracted by what's going on intraday, and you're just sitting back and coming up with a great plan. As I showed you guys, it wasn't a lot of entries or exits. It was just, I'm in here, I'm out here, I'm in here, I'm closing a swing here, realizing gains, putting the money to use at an in the money call option, letting it expire, bringing my average down, and now I'm exactly in the position that I would like to be at PLTR. Leave a comment down below if you have any questions. Don't forget to like the video. Don't forget to subscribe. Share this video. Show some love if you've never seen anything like this. I took a few months off just because January was my most profitable month yet. I needed to be focusing on trading. Also, there was the holidays, but I promise you guys I'll be putting out more content this year. I'm hoping to show you guys different ways of how you can approach the markets, as opposed to just, oh yeah, I made $5 grand doing this on buying some YOLO calls on this crazy trade. I really like focusing on planning, strategizing, and keeping risk low. Starting with this example, by selling these puts here as opposed to buying the shares and buying the $20 put, it meant my risk was over $100 my risk was only $1,000 over 4 weeks. That is very low risk considering how much I could have had in risk if I was to just buy the 400 shares right here, or the 300 shares, 500 even. Okay, now it sounds like I'm probably just repeating myself, so I'm gonna cut the video here. Thanks for watching, guys. Catch you in the next one. Peace.